everyone, welcome to Commerce Excellency Academy UGC NET JRF coaching. In this video, we will discuss the topic monetary policy. So what is monetary policy? It is the process by which the monetary authority of a country controls the money supply of the economy by its control over interest rates. Okay, so monetary authority can be the central bank of the country. According to Indian perspective, it is Reserve Bank of India. So what are the monetary measures taken by the Reserve Bank of India to control the money supply in its economy so that the inflation or deflation can be controlled and to stabilize the economy? The objective behind a monetary policy can be any one of the following. It can be to control inflation, to reduce unemployment ratio, to ensure price stability, to stabilize GDP, that is gross domestic product, or to maintain predictable exchange rate with other currencies. So what are the types or approaches of monetary policy? A monetary policy adopted by the central bank of a country can be of two types: expansionary monetary policy and contractionary monetary policy. So most importantly, there are two types: expansionary and contractionary. There is one more approach, that is neutral monetary policy, that we will discuss later. What is expansionary monetary policy? Expansionary monetary policy is the policy adopted by the central bank which is used to stimulate the economy. So the main aim behind introducing expansionary monetary policy is the growth of the economy. They want to increase the money supply in the economy. So it maintains short-term interest rate as lower. So whatever the Reserve Bank, if the Reserve Bank is following an expansionary monetary policy, then the short-term interest rates will be lower so that it increases the total money supply in the economy more rapidly than usual. So we will see how expansionary approach works. First, the Reserve Bank lowers the interest rate. It helps in the availability of less expensive credit. So whoever is approaching for a loan, either for any personal purpose or business purpose, the interest rate will be very low, so the availability of less expensive credit will become possible. It helps in expanding the businesses. Through the expansion of businesses, increase in aggregate demand for goods and services will become possible, which boosts the short-term growth, that is increasing GDP. Now we will move on to contractionary monetary policy. It is just a reverse to expansionary monetary policy, or is opposite of expansionary monetary policy, which maintains short-term interest rate higher than usual. So what happens is, as the short-term interest rate is very high, it slows the rate of growth in money supply. How contractionary approach works? The central bank increases the short-term interest rate. So as an impact of this, the credit system becomes highly expensive. That means the loan availability will become highly expensive, which will result in slowing down the short-term economic growth. As a result of this reduced economic growth, which lessens the inflation rate. So if these two approaches, that is expansionary and contractionary approaches, are not used cautiously, it will have some adverse effect. Expansionary approach, if you are using vigorously, it will cause diminishing the value of currency related to other currency. What is the adverse impact of contractionary approaches? It may result in increased unemployment and economic recession. As I have mentioned earlier, there is one more approach, that is neutral monetary policy, which will be neither expansionary nor contractionary. So there will be no change in the prevailing economic conditions as it is considered as a perfect economic condition. The central bank is not going to make any changes in the prevailing interest rates. So we can say it as a neutral monetary policy. Hope you understood the concept. Don't forget to subscribe our channel. Thank you.